In these two tutorials, we will learn about the conceptual framework for financial reporting and the financial reporting standards. We will learn about the objective of financial reporting and the importance of financial reporting in security analysis and valuation, the role of financial reporting standard bodies such as the International Accounting Standard Board and the Financial Accounting Standard Board. We will also learn about the conceptual framework and journal reporting requirements under IFRS by the International Accounting Standard Board. IFRS stands for International Financial Reporting Standards. We will also learn about the alternative financial reporting systems and their implications for financial analysis. The International Accounting Standard Board, that is IASB, sets the International Financial Reporting Standards IFRS. The IASB has set out the objective of financial reporting in the conceptual framework for financial reporting, generally known as the Conceptual Framework, which was issued in September 2010, replacing the Framework for the Preparation and Presentation of Financial Statements 1989. The conceptual framework sets the objective of financial reporting to provide financial information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. The decisions include buying, selling, or to hold equity and debt instruments such as common stocks and bonds, as well as credit analysis, etc. Investors in equity and debt have to decide whether they should be going long, that is buy or short the securities of the company. If they already own the security, they are interested in whether to hold them or sell them if the outlook for financial performance and position is not promising based on their analysis of the financial reporting. The Financial Accounting Standard Board, that is FASB, sets the US GAAP's generally accepted accounting principles. In September 2010, it also issued Conceptual Framework for Financial Reporting, that is the Concept Statement number 8, replacing its Concept Statement 1 and 2. The conceptual framework identifies existing and potential investors, lenders, and other creditors as the primary users of financial statements, and there are three basic reasons that underlie this choice. First, these primary users have the most critical and immediate need for the information in financial reports, and many cannot require the entity to provide the information to them directly. Second, both the FASB and the IASB are required to focus on the needs of participants in capital markets, that is, investors of both equity and debt securities. Third is that meeting the needs of these primary users is likely to meet the needs of other stakeholders as well. Financial reporting standards determine the types and amounts of information that must be provided to users of financial statements, such as the creditors and investors, to make timely and informed decisions. Financial reporting standards therefore provide the rules or principles that are followed in the preparation of financial statements by reporting entities. It is important for the analyst to develop a thorough understanding of the underlying framework of financial reporting standards. By doing so, the analyst is able to assess the implications of financial statement elements, that is assets, liabilities, owner's equity, revenue and expenses, and the transactions for valuation as well as other financial analysis. Both existing and potential investors have to make decisions to buy, sell or hold securities, which may be debt or equity, depending on their expectations about the returns from these securities, such as dividend yield or price appreciation or interest income. Now, expectations about the dividend yield, price appreciation or interest and principal payments depend on the prospect of an entity's future cash flows and its financial position and performance as expected. Therefore, the users of financial statement to make these decisions require information on the resources, that is assets, claims on those resources, that is liabilities, and the use of those resources by management and board, that is the income and expenses, as well as the cash flows of the company. Though the financial reports provide information that the analyst or the users of financial statements may find very useful to value the reporting entity, they by themselves do not show the value of the reporting entity. So just by looking at the financial statements of a company, one cannot determine its value. However, using the information reported in the financial reports, the analyst or the users of financial statements may be able to determine the value of the company. As we know, for a thorough analysis, information on economic, industry, as well as company competitors is required. So users of financial reporting will require to obtain information on economy, industry, and competitors from other sources as well. This may include information on general economic conditions and expectations, political events and political climate, and industry and company outlooks. In the past, each country used to have its own independent standard setting body which was responsible for issuing and setting financial reporting standards that were applicable in that jurisdiction. This practice led to the development of a wide range of standards. Some of these standards were quite comprehensive and complex, which we also know as rule-based standards, and others were more general, which we know as principles-based standards. Rule-based standards require companies to adopt to them and comply, and therefore are considered rigid. Principle-based standards, on the other hand, allow flexibility and companies can adopt them according to their own circumstances. In principle-based framework, reporting entities may interpret similar transactions differently. This involves second guessing and it also creates uncertainty. Further, it also requires extensive disclosure on these transactions in the financial statements. Accounting scandals over time as well as the financial crisis of 2008-2009 have created more awareness among the users of financial statements, regulators, and other stakeholders for developing uniform, high-quality financial reporting standards. The ever-increasing globalization of capital markets has also contributed towards the need for a uniform financial reporting standard framework. This, however, is not an easy job. The complexity involved in standard settings is just a reflection of the complexity of the underlying economic reality of the financial reporting entities involved. Over time, businesses have grown and have become more complex in their operations. It is becoming increasingly complex to reflect the economic reality of businesses such as Apple, Amazon, and Google in their financial reporting. Information provided by financial reporting must be timely and at the same time it must be accurate. However, there must be a trade-off between accuracy and timing given the complexity and uncertainty that leads to judgment in preparation of financial statements. Given the variation in judgments in the preparation of financial statement, standards are required to achieve consistency across companies and across jurisdictions in the preparation of financial statements. Despite standards, there will always be no correct single answer to the question on how to reflect economic reality in the financial reporting. However, financial reporting try to limit the range of acceptable answers to increase consistency in financial reporting. It is essential for an analyst to develop a thorough understanding of the financial reporting framework so that he or she knows how and when judgments and estimates affect numbers that are reported in the financial statements, and it enables the analyst to evaluate all the information that is reported and to use it appropriately when assessing the company's financial position and performance. Understanding the financial reporting framework of an entity also helps the analyst in assessing the financial impact of the business decisions as well as making comparisons among entities. To develop our understanding of the issues involved in judgment and estimates, let's have a look at this example. Gourmet Cookware has the following transaction for an accounting period: acquired office equipment for $9,000 in cash, paid rent and other miscellaneous business expenses of $10,000, purchased 100 sets of cookware at a cost of $700 each and paid 100% on delivery. So the purchases of 100 sets of cookware at $700 is all on cash basis. Sold 60 sets to customers for $1,200 each. So 1200 multiplied into 60. So total revenue from the sale of these 60 sets was $72,000. In order to make the sales, InCook had to offer credit terms to many customers. So at the end of the year, it had to receive $15,000 from its accounts receivable, which means that $57,000 in cash was collected during the year, and hence $15,000 was still outstanding at the end of the year that the customer needed to pay in the next accounting period. If InCook's two owners plan to split the profit 50-50 and there exist no accounting standards, what alternatives might be proposed as reasonable ways to compute the profits? Judgments will be required with respect to office equipment, expenses as well as sales. For example, should the company report all the $9,000 paid for buying the office equipment as an expense or report a proportion of it as depreciation expense? Similarly, the company purchased 100 sets of cookware at a cost of $700, that is $70,000 were paid to buy these 100 sets of cookware. Should the company report $70,000 as an expense in this period's income statement, or should it record only the cost of the 60 cookware sets, that is $42,000, 60 multiplied by 700 as an expense in the income statement? Finally, the 60 units that were sold for $1,200 each, that is $72,000. Should the company report $72,000 in sales revenue in this period, or should it report only $57,000, that is the amount of cash collected from selling the goods? The maximum profit will be $20,000 if the company reports sales of $72,000, cost of goods sold of $42,000, which gives gross profit equal to $30,000, and if we deduct rent from it of $10,000, that is $20,000 net income. On the other hand, if the company reports sales of $57,000, which is equal to the amount of cash collected from sales, and deducts from it the cost of goods sold of $70,000, which is equal to the cost of all the 100 sets of cookware, the gross profit or loss will be equal to $13,000. And from this, if we deduct the expenses, that is rent, $10,000, and also the office equipment of $9,000, we get total equal to $32,000 in net loss. Here we can see in the absence of standards, there is a great divergence between the net income reported here and the net loss reported here. So whether the company has earned money or has incurred a loss is not clear. Accounting standards, however, do exist, and they reduce the range of allowable approaches that can be used to report financial position or performance. In the case of InCook Incorporated, the sales revenue will be $72,000. However, this amount will be reduced by an estimate of the uncollectible accounts because the company has sold some of the sales are on credit. Cost of goods sold will be equal to the number of units sold multiplied by the cost per unit, which is equal to $42,000. If there were variations in per unit cost, then we would have required to use inventory cost methods such as FIFO or LIFO to calculate the cost of goods sold. To report the cost related to the office equipment as an expense for this year, the company would require to make assumptions or judgment regarding the estimated useful life of the equipment, estimated salvage value of the equipment at the end of its useful life, as well as the choice of a depreciation method such as straight line depreciation method or double the straight line depreciation method to calculate the depreciation expense that should be reported in this year's income statement. Standard setting bodies set the standards for financial reporting. These are typically private sector and they are self-regulated with board members who are experienced accountants, auditors, other users of financial statements, as well as academics. The two most important financial standard setting bodies are International Accounting Standard Board and the Financial Accounting Standard Board. Regulatory authorities, on the other hand, recognize and enforce the standards that have been set by the standard setting bodies. Regulatory authorities are governmental entities. They have legal authority to enforce financial reporting standards in their respective jurisdictions. However, they also have the power and authority to overrule the private sector standard setting bodies. This implies that if there is a contradiction between the guidance of the standard setting body and the regulatory authority, the reporting entity is required to comply with the regulatory authority's guidance. Securities and Exchange Commission in the United States, Accounting and Corporate Regulatory Authority in Singapore, and the Financial Conduct Authority in the United Kingdom are examples of regulatory authorities. The Financial Conduct Authority was previously known as Financial Services Authority. International Accounting Standard Board, that is IASB, sets the International Financial Reporting Standards, generally known as IFRS. Previously, the board used to issue International Accounting Standards known as IAS. However, it now issues only IFRS, that is International Financial Reporting Standards. The reporting standards in the US are called US GAAP, Generally Accepted Accounting Principles. The Financial Accounting Standard Boards in the United States issues the US GAAPs. Every country has its own regulatory authority. Like in the United Kingdom, we have the Financial Conduct Authority. In the United States, the regulatory authority is the Securities and Exchange Commission of United States. The International Organization of Securities Commission was formed in 1983. Basically, it's not a regulatory authority, but it's an international association of the securities regulators across the world. The objectives of the International Organization of Securities Commission are developing international standards of market regulation so that investors are protected and systematic risks are addressed, exchanging information and cooperation in enforcement with the objective to enhance investor protection as well as promote investors' confidence in financial markets, and finally exchanging information to assist in development of markets, infrastructure and regulations across the member countries. Though many countries have adopted the International Financial Reporting Standards, however, there are certain exceptions, such as the United States. Financial reporting standards, both the International Financial Reporting Standards as well as the home-based accounting standards, have evolved over time for various reasons. These include changes in economic activity, including new types of products and transactions. For example, financial technology has resulted in new financial products as well as new types of transactions such as P2P online lending, improvements to existing standards, as well as the convergence between the International Financial Reporting Standards and the home country standards such as the US GAAP. Therefore, the analyst needs an understanding of whether and how differences in the financial reporting standards affect comparability in cross-sectional analysis across time and across jurisdictions. Despite significant efforts to converge accounting standards across different jurisdictions, differences remain. The most prominent of these is between the International Financial Reporting Standards and the US GAAP. This is despite the efforts made by the International Accounting Standard Board and the Financial Accounting Standard Board toward the goal of a single set of high-quality, globally accepted accounting standards. Here we discuss four of these significant differences between US GAAP and IFRS, and the first one is the reporting of inventory. LIFO, that is last in first out costing methodology for inventory, is not permitted under IFRS. However, the US GAAP permits the use of LIFO method for inventory costing. This difference has significant implications for operating results and income taxes payable by US companies. The Internal Revenue Service in the United States allows the use of LIFO method for tax purposes only if the same is used by the company consistently for financial reporting purposes. To achieve convergence, if LIFO is eliminated from US GAAP, it will be automatically eliminated for use with the Internal Revenue Services for tax purposes. Another difference between IFRS and US GAAP is the measurement of certain asset classes. The IFRS allows the measurement of certain asset classes such as capitalized acquired intangibles and property, plant and equipment initially at cost. Thereafter, reporting entities may choose an accounting policy by asset class to continue with the cost model or revalue the assets within each class to fair market value less any subsequent accumulated amortization or depreciation expenses. The use of revaluation models are not allowed under the US GAAP. In addition, the IFRS allows the use of either the fair value model or the cost model to account for investment properties. However, the US GAAP only allows the use of cost model for investment properties unless certain conditions or criteria is met. These include if the entity determined that it is an investment company, or the entity is controlled by a pension plan that is required to measure its investment at fair value, or that the entity follows industry practices that have developed over time allowing fair value measurement for real estate investments without regard to investment company attributes or pension plan ownership. Another difference between IFRS and US GAAP is the reporting for impairment for property, plant and equipment, inventory and intangible assets. The IFRS allows the reversal of impairment losses up to a certain amount if there is an indication that the impairment losses recorded earlier have decreased during the reporting period. The US GAAP does not allow any reversal of impairment losses, and this is considered to result in differences in the timing and extent of recognized impairment losses. It implies that IFRS models will result in higher income statement volatility if any company is using these. Higher earning volatility leads to higher risk and lower stock prices and valuation. In case convergence is achieved and US issuers are required to adopt the IFRS models, it will result in higher income statement and earning volatilities for them. US GAAP and IFRS also differ in the recognition of certain non-financial liabilities such as contingencies and environmental liabilities. The recognition of such liabilities is governed by the probability that the liability has been incurred under both US GAAP and IFRS. However, the definition of probable varies from IFRS to US GAAP. Under IFRS, probable means more likely than not to occur. Though not written in standards, in practice, this means more than 50%. Under the US GAAP, probable means the future event or events are likely to occur, and likely here is a higher threshold, and again in practice it implies more than 70% probability. So likely is a higher threshold. So therefore it is more likely that the IFRS will record a liability earlier than it is recorded under the US GAAP. This difference again has implication for differences in reported financial position and performance under both IFRS and US GAAP. In the next tutorial, we learn about the conceptual framework for financial reporting and the fundamental as well as the enhancing qualitative characteristics of the financial reporting.